The collapse in the Turkish Lira tips emerging market indices into bear markets. Turkey was not an obvious catalyst to awaken sleepy Northern Hemisphere summer markets. Its economic struggles have been clear for some time. President Erdogan has been reluctant to raise rates and slow spending to address an overheating economy, and with the appointment of his son-in-law as finance minister, markets have increasingly lost confidence. But the lira's losses accelerated with the deepening diplomatic spat with the US, and we saw a collapse in the Turkish lira on Monday drive waves of risk aversion around global markets, leaving the MSCI Emerging Market Index down about 20% from the January highs. The Turkish lira fell a staggering 13.7% last Friday and a further 9% in the first couple of hours of trading on Monday, though by the end of the week had recovered by about 20% from the worst levels. While such volatility in illiquid emerging market currencies is not unheard of, it was reports that the European Central Bank was worried about the impact of the sliding Turkish lira on some large Eurozone banks that pushed global markets down. This saw European stock markets under pressure and the euro all but hit 113, the lowest level seen for the common currency since mid-2017. So far this year, we've seen three mini-crises in global financial markets. In February, with the blow-up of short equity volatility strategies with the destruction of short VIX funds. Late May, early June, it was the crash in the Italian government bond market as a result of political developments there. This last week, it was the Turkish lira's turn to tumble. With the European Central Bank and the Bank of Japan tapering their asset purchase program, the Fed removing liquidity and raising rates, financial conditions are tightening around the world. With the Fed set to raise rates in September and likely December too, this story is set to continue. This will keep markets focused on potentially significant risk events in the months ahead, and September brings a number of key potential tipping points. The US administration will make a call on the proposed 25% tariff on $200 billion in Chinese exports in September. US political risk will make a comeback as midterm fever usually takes hold from the Labor Day holiday on September 2. Finally, questions over Italian debt sustainability will return as a market focus in September 2 as the populist government fleshes out details of their contentious 2019 budget that will likely draw the ire of both ratings agencies and the European Union. Thus, markets are likely to remain cautious through the end of August and into September, even if there was a lift in sentiment into the end of this week as investors welcomed a planned US-China meeting on trade that will take place next week in Washington. This rise in volatility exacted a heavy toll on the Australian dollar. After barely threatening to break out of its 73 to 75 prison for about 8 weeks, the Australian dollar finally broke lower last Friday as European markets slumped. An added weight on the dollar came from the slump in commodity prices, with copper below 6,000 at one point on the Thursday to be down 20% from the June highs. The dollar hit an 18-month low at 72.03 on Wednesday. The unexpected drop in Australian unemployment rate to a 6-year low of 5.3% did help the Australian dollar bounce somewhat on Thursday, but this had more to do with a drop in the participation rate. Employment fell by 3.9 thousand in July, limiting the follow-through in the Australian dollar, and it's likely that we'll continue to hug 72.50 closely into the beginning of next week. Now, it's a fairly quiet week next week in terms of major market events. We do have the RBA minutes on Tuesday and the Federal Open Market Committee meeting minutes on Wednesday. The Chinese trade mission to the US takes place Tuesday, Wednesday next week, and that will be a key focus for financial markets. Finally, we also have the Federal Reserve Bank of Kansas City's Jackson Hole Economic Symposium, which brings together central bankers, economists, investors, and global media. This year's title is The Changing Market Structure and implications for monetary policy. The symposium will take place Thursday through Saturday next week. These are all factors we can talk about in next week's Markets Update.